Welcome to Let's Talk Somerville Real Estate. I'm Rick Kaplan from the New England Real Estate Journal, and I have sitting next to me, I have Deborah Byrne, and Deborah has 36 years of highly trained experience selling real estate. She has been trained in selling commercial properties, strip malls, land, ground leases, restaurants, multiple dwellings, multifamilies, condominiums, and single families. Deborah has been involved in many successful closed 1031 exchanges. Just a few of Deborah's awards and designations are Top 4% Sales Award nationwide, Certified Relocation Director, Government Certified, Performance Certified, Chairman's Circle, President's Circle, Top Producer in Massachusetts Awards. Deborah's company Prudential just merged with Berkshire Hathaway Home Services Varani Realty, still at the same location in Davis Square in Somerville. Deborah is thrilled with the additional global listing exposure she can provide for her past and future clients with this strong and powerful organization. Please call Deborah and her team of professionals for all of your real estate needs at 617-201-4730. And next to Deborah, we have Patricia Flowers, well, as Patty we know her as. And Patty is a vice president with Investment Property Exchanges Services, Inc., the largest and most secure qualified intermediary in the country. And in 2004, Patricia received one of the first industrial awards certified exchange specialist designations. In her role, she strategically guides tax and legal advisors and their investors through the process, structuring transactions to succeed within the parameters of the IRC Section 1031 code. And if you haven't been able to tell, we are going to be talking about 1031 exchanges today. And I think we're going to start with Patty. Patty, you want to explain a little bit about what a 1031 exchange is?
Sure, I'd be happy to. So Section 1031 is part of the tax code, and what it says is that if you own an investment or income-producing property, when you go to sell that, normally you would have capital gains tax to pay, about a third of whatever you made. So instead, you can set your sale up as a 1031 exchange, defer paying those taxes, and actually get to keep that tax money working for you to go on and buy new real estate.
And Deborah?
Well, Patty's firm is a qualified intermediary called 1031 Tax Deferred Exchange, which the IRS states an owner must have a qualified intermediary. And Patty is in Boston, her firm is. And we're here now because Patty is very skilled in how to save you thousands of tax dollars when closing on properties.
Yeah, so a really good example of that actually is, say that you bought a property for $500,000, a multifamily, for example. You bought it for $500,000, you've been renting it out for X amount of years, and now you want to go on to sell it, say $800,000 is your sale price. So you may have made some improvements to the property, etc., but just for easy math, you bought it for $500,000 and you're selling it for $800,000, you've made $300,000. That means you have to pay about a third of that in taxes when you sell it. So instead of paying that $80,000 or $100,000 in taxes, you can actually take that money and roll it into new real estate. So you can go on and buy another multifamily or a commercial building or any type of other investment real estate, and just now you have more equity to put into that new property.
Now, did you have a question?
I have a question. Can we talk about when it's someone's primary residence? A lot of people are under the assumption that they can't defer an exchange with their primary residence.
Right. So actually, primary residence sales specifically have their own tax code, Section 121. So if you've lived in that property 2 of the last 5 years, you can actually get a $250,000 or $500,000 exclusion on that gain. So that's really tax-free in your pocket when you sell as a primary residence. But some people will do 1031 exchanges, sell investment property, and buy possibly a condominium or a single family that's going to be a rental for X number of years, maybe 2, 3, 5, 10 years, but eventually they want to move into it and convert it to their primary residence. And they can do that as well.
Excellent, excellent. Okay.
So I don't have any other questions
Oh,
right now.
okay,
You're more
okay.
than welcome to keep going.
I've done a lot of 1031s, and it's a very short window that you have. Can we talk about what the window is for the exchange, and if that doesn't work, how about a reverse exchange? Can you tell us about that?
Sure. So in a regular forward exchange, you have very specific timelines. So the clock starts on the day of your sale closing. You have only 45 calendar days to identify, to list what you're going to buy. That's really hard to do, especially in a busy market. So you have 45 days to list what you're going to purchase, but you have actually 6 months to buy it. So sometimes what happens is people are very concerned about that 45 days and are they going to be able to secure a property and is it going to go through in that short window. So what they'll do is set up a reverse exchange, which is a little more complicated than the regular forward exchange. But what happens is you're actually able to designate what you're going to buy first. So if you have something you know is going to sell and you're pretty confident that it's going to go quickly, you could actually go and purchase something else first and sell second. So you're actually going in reverse in an exchange. And that actually alleviates the 45 days.
Thank you, Patty. That's
Yeah.
really helpful. What about a situation when say if the seller lives in a 3-family and their primary residence is one of the units? How does that work with an exchange?
So they term that a mixed-use property, where part of the property is primary residence and part of it is investment. So, for example, if you had a 3-family and you were selling that for $600,000, if you assumed that each unit was the same square footage, then a value of each unit would be $200,000 each. So you're living in 1/3 and you're renting 2/3 out. So every year on your tax return, you're reporting income and expenses for those 2/3 units, and you're reporting a primary residence on the 1/3. When you go to sell that property, even though it's one sale and one closing, you would have one listing, one seller, one buyer, it's actually two tax transactions. So when you sell, at tax time, you report a primary residence sale, which is tax-free for the 1/3 unit, and the 2/3 units, you would report that as a 1031 exchange, and you could go on and defer the taxes from the rental portion by doing an exchange and rolling the money through the exchange account.
That's excellent, Patty. Thank you very much. Now, what about a situation where people they don't want to manage their property anymore, and they decide that they want to defer the gain? How would you go about doing that?
So oftentimes people are selling investment property. They have to go on and buy other investment property. But a lot of times you'll hear them say they're kind of tired of managing tenants and toilets, and they just want to be done. They've done this all their life. It's getting a little bit tiresome. So there are opportunities on a national scale to buy replacement property. Some are run through the securities industry, which have their own regulations attached to them. But they're properties similar to REITs. So typical REIT is a real estate investment trust where you have funds and you put it into a REIT. They may own 5 or 10 properties, but by putting that in there, you now have shares. So you have a little piece of all those different properties within that one REIT. REITs don't necessarily qualify for a 1031 exchange because of the way that the property is held in shares, but those same sponsor companies actually have other programs that are designed for 1031. So you might sell your $1 million commercial building or rental property here, and you might take that money and put it into a couple different properties in this DST sector, which is kind of hands-off management. You're invested in a couple different properties, maybe to diversify a little bit, but you're getting the income, you're getting the expenses and the write-offs, and by doing that, you've done a true 1031 exchange, and you've deferred the capital gains tax that would have been due.
So that's actually, you could call that a REIT, but it's a separate type of REIT that would only handle 1031 transactions.
It is. So, right. So it functions like a REIT, but in a REIT, you own the shares, and shares don't qualify for a 1031 because you're not on title to the new property. In a 1031 exchange, you're selling real estate and you're buying real estate. So you have to be on title for your percentage. So what these REIT companies did was they turned around and formed these other groups, and now most common, they used to be tenant in common, TIC properties, TIC. A lot of them have switched over to what they call DST, Delaware Statutory Trust. It's similar to a REIT, but instead of owning shares, you actually have a beneficial interest of ownership on the real estate. So you actually own a 0.053% of that Avalon apartment complex or Home Depot or whatever it may be, corporate building. So it works the same as a REIT, but it satisfies the title regulations in a 1031.
So does your name go on to that title?
Actually, there's a trust that's on the deed, on the title, and then there's beneficial owners. So you may have 10 or 20 percentage owners in that trust, and they own no different amounts depending on how much money you put into the property.
That's interesting.
Yeah.
to know.
Excellent.
Yeah,
mean,
it's a good option for people who kind of want that hands-off,
Right.
a little bit done with it. And certainly there are other choices. You may even decide to have a little hands-off management, but buy something in a vacation area or a ski country or down south where you pay an extra little bit of money for a management company. They clean the place every week. They rent it out through their rental pool, and you still get the income and expenses and write-offs, but you don't have the day-to-day headaches.
Right, so you don't manage it.
Exactly. Yeah. Yeah. So there are some very good options for people who really are pretty much done with the day-to-day.
Fantastic, Patty. And what about, we had talked briefly about when somebody continues to transfer and do gain 1031 exchanges, and upon their demise, their death, what happens to that property in regards to their heirs? Do they have to pay an exchange, or how does that work?
Yeah, so one of the great estate planning benefits of a 1031 exchange is they kind of refer to it as exchange, 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 and die. So if you love your heirs, that's a really good thing, because what happens is that as you keep exchanging, that depreciation you've taken, the capital gains that would be due if you sold it outright, instead are really deferred, which means they're following you on paper from property to property. So you do an exchange, you don't pay any taxes, you hold it for 3 years or 5 years or what have you, you do another exchange, again, you don't pay any taxes, so it's following you on paper as you go. In the end, if you decide, I'm done with this and I'm gonna turn around and sell outright the last property that you have, all the taxes would be due that have been following you, gains and losses along the way, depreciation taken, it would all be due, and then the remainder would be yours to pass on to your heirs or give out or to live off of. Instead, if you would keep exchanging, when you pass away, the basis, so the very bottom line from the very first property you bought years ago, that basis rolls up and the value is to that property at the date of death, and it turns over to your heirs capital gains tax free. So instead of them owing all the capital gains tax, or you owing all the capital gains tax if you sold it outright, it goes to your heirs and they can sell the property and use that money for whatever they want. They don't have to buy more real estate with it. It's a great estate planning tool.
It really is. So you can always pull an equity line out once you do your exchange, and then you could free up some cash that way after you defer your taxes, which is a win-win.
Yeah, I think people have to be careful. There's not a lot of specific guidance on when you refinance to pull cash out.
Okay.
Certainly you do a 1031 exchange because no one wants to pay the tax.
Right.
But a lot of times people do want to pay themselves back for improvements they've made or need some cash for other things and have the built-in equity. So they want to get that equity out. So often, because there's no specific regulation on it, a lot of times we'll suggest that if they can wait till the next tax year to refinance or till some extended period of time. Really, the only rule in place is that any refinance cannot be connected to the exchange itself.
Mm-hmm.
So you never want to do one right after the other.
Okay. Can you ever refinance after you do an exchange? Like you said, just for improvements, just to pull your money. When would there be a time frame that would be acceptable?
Yeah,
that you could
unfortunately,
do
the
that?
IRS doesn't have an exact timeline written.
Okay.
So it's really a comfort zone. A lot of times we'll say, go back to your tax advisor. What are they comfortable with waiting for an extended period of time? Some will tell you the next tax year. Some say that, if your intention is not to skip out on the taxes, your intention is to pull that money out to improve the property. That's a very good reason. But right now, there's no written timeline.
So you really have to have, the guidelines are pretty strict, so you really should be dealing with professionals that are pretty used to, and you being an intermediary. Let's talk about what happens if you don't use an intermediary, if somebody hasn't had it set up yet. How would you step in after the fact if it's within the 45 days?
Right.
How would you work that?
So the rules are very, very specific on this. And in the 1031 code, the IRS says that you as the seller cannot control the funds in between your sale and your purchase. You need a neutral third party to facilitate the exchange. So that's us. IPX is the qualified intermediary. So anytime up until you have a purchase and sale agreement, anytime before the closing, we would get involved in that 1031 exchange. But if you've sold the property, it's closed, you've taken the funds and you've gone home, whether you still have a check or it's been wired to your account, even if you haven't spent it, it's actually too late to do a 1031 exchange. Our hands are tied. It's an IRS rule that the taxpayer or anyone related to them doing business with them, so their attorney, their accountant, their advisor, financial advisor, cannot control the money in between the exchange. And that's a tough call. We get that call often where someone sold property, they just found out they could do an exchange, they had no idea, someone mentions it to them, and they want to go on and do it, and if they've already taken the money and the sale has closed, they can't do it, they owe the tax.
So even if they purchased another property, they still have to pay that capital gains on that tax, on the net amount that
Yes,
they
if
made
they
up?
didn't follow the specific guidelines, yes. So you must have a neutral third party. So what we do as the intermediary is you do your purchase and sale agreement as normal, but what'll happen is when you and your client have the P&S with the buyer and everything's been negotiated and worked out, we'll take a copy of that from you and we do an assignment. So we'll assign in to be able to receive the proceeds. So we're actually on paper with you at the closing, even though we don't attend. So we assign for the benefits of the exchange, which are the proceeds. So it's not like a 401k where you do a rollover and as long as you reinvest it in 6 months, you're fine. Doesn't work that way. You absolutely have to have the neutral third party set up the exchange account, prepare the documents, assign in, and control the proceeds in between your sale and your purchase.
So at that time, you need to have the buyer for your property, and you have to have the property that you're going to purchase with that, the proceeds from the sale.
Yeah, I mean, often when people call us, they don't know what they're buying yet, so that's okay. But we have to be set up for the sale, and at the day of the sale closing, that starts that timeline that Deborah referred to earlier.
The 45
The
days?
45 days, yes. So as of the day of the sale closing, we've assigned in, our documents are prepared, we've opened an exchange account, like an escrow account for that taxpayer. The proceeds get wired in, and then we say go. You have 45 days to identify what you want to buy. So they can go under P&S for something later on after the sale closing for purchase, but we have to be in place before the sale side.
But, so they can, as long as they have a purchase and sales, they don't have to have a closed deal in the 45 days.
180
Right.
days, is that correct? 180 days to close, Patty?
It's 180
time?
days to close is the maximum. So sometimes in that 45 days to identify, they might not even have a purchase and sale. They may be just looking, trying to evaluate, doing a little bit of due diligence on the side, and they might get to day 42, 43, 44, and still not be under contract for anything. They can still identify to us because it's just listing it on our form, but they have to continue on. After day 45, you cannot go back and identify anything else. So that's the tricky part.
So would you recommend somebody identify a few properties, 2, maybe 3?
Yep, that's a great idea.
Okay.
You can definitely list 2 or 3 properties to us, even though you have one in mind. Even if you have one under P&S, it's definitely a good idea to give some backup. Because if that one falls through after day 45, the number 1 property that you want, if you did not list a second or third, you're all done. The exchange is over. because you cannot go back and add to that list after day 45.
This is great information. Great information.
Oh, thank you.
And there is a cooperating clause that should be put in the purchase and sale as well. Is that correct, Patty?
Yes,
You want to
yep.
talk about that?
Yep. So often people, when they make an offer, don't necessarily know they're going to do a 1031 exchange at that point. Maybe they're not sure, or they don't even know it exists. So you as the realtor will go through the whole process, prepare the P&S. When it comes to us for review, if we don't see any 1031 wording in there, we'll send something out to you. And so it's just a recommendation and a notice to the other side. So it'll say that the seller intends to do an exchange, the buyer agrees to cooperate, and sign anything that may pertain to the exchange at closing. But the nice thing about that is, for the opposite party, there's really no downside. There's not a negative. So it's just a notice giving information that someone is assigning in with the seller, but it does not affect the buyer in any way. It doesn't affect them from a cost perspective. It doesn't slow down the closing. It doesn't detract from anything in their negotiations. It's just an FYI.
Excellent. Can we clarify a reverse exchange? Because right now there's no inventory on the market. Can we just clarify one more time about a reverse exchange?
So if you're in the Somerville, Cambridge area, you have a property that you want to sell for investment, chances are there's a buyer out there for you. It's going to get some good money coming in. You might even have multiple offers, who knows? So you're pretty confident that that will sell quickly. But on the flip side, if you're looking to buy something in very hot markets, it's hard to find property. So what you might do is you might hold this property, get your sale property ready to go, ready to list, but not list it yet. Meanwhile, have your realtor, you be out looking for replacement properties, searching for new property. If you find something, do your due diligence, get it under contract, get it under agreement. And if you can schedule that purchase and sale to be contingent upon the sale of this one, then great, it's a forward exchange. But if not, and you have to buy before you sell, so you lock something into purchase and sale to buy, and you have to close on that before the sale, you can do that, and we set up a reverse exchange instead. It's a little trickier. The taxpayer is not allowed to be on both properties at the same time, so we have to set up an entity to step in. IPX has a special division of attorneys and staff that just focus on reverse exchanges all day, every day.
Okay.
So there's a little bit more to it. It's not a last-minute transaction. There's a lot of planning that goes into it. But in the end, a reverse exchange can save someone the stress of the 45 days that they may get locked out of an exchange, and they still get the full tax deferral.
So what is there is no timeline what is the timeline for the reverse exchange? Is it the same?
It is the same.
Oh, it is the same. So it's the 45
Yes.
and the 180.
Yes, but
Okay,
the comfort though in a
I see.
reverse is that if you're buying first, you have 45 days to identify what you're going to sell, and you know what you're going to sell because
Absolutely.
you own it. So, and
It
you're pretty
frees you up,
comfortable that
yes.
it's going to go, and you definitely would be able to sell it within 6 months because it's in a Somerville, Cambridge area is really, a strong market right now.
Mhm.
So it'll be able to sell. So you still have the same timelines in reverse. It also works well for foreclosures, people who are going to foreclosure sales or have quick buys where they have to do a quick cash purchase and they don't have time to get this other one on the market. A reverse works very well.
How about, Patty, if the property is set up in a trust? Will that affect the exchange in any way?
No, well, actually, any entity can do a 1031 exchange. So you could be an LLC, a corporation, an individual, a trust. Any entity can do a 1031. The trick is the vesting regulations state the same entity that sells must be the same entity that buys. So if the trust is on title and is the seller, the trust needs to be the buyer on the other side.
I have a off-the-wall kind of question.
Okay.
If you sell a property in the United States and you want to buy a property outside in another country, would that qualify in a 1031?
So that's not so off the wall, actually. People do call about that. No, it doesn't qualify. So like-kind property, as it's termed, is really, the IRS considers U.S. for U.S. property. Foreign property is like-kind of foreign. But U.S. property, if you're selling, is not like-kind to foreign. You can do a 1031 exchange with any property within the U.S. and any of its possessions except Puerto Rico. So Puerto Rico property you cannot do a 1031 exchange with, but U.S. Virgin Islands, Guam, any of the U.S. possessions, and of course, anything in the United States.
Well, we're getting close to our time here.
Yeah.
Are there any missing pieces of 1031 that we haven't talked about that you could really give us a really quick answer to, if someone's interested?
Yeah, I mean, I think if someone's thinking about doing an exchange, it's always better to call sooner rather than later. Give Deborah a call, give myself a call, and really try and talk through what is it that your plan is. So that's always my first question. What are you selling? What do you plan to buy as replacement property? Because people have very specific things in their head that they're planning to do, but in reality, it might be harder to orchestrate that in the short timelines. So I always think they should call ahead of time. The timelines are certainly very important. The dollar value rules are very important. The goal is to buy equal or greater value than the sale price, what you sold. There's a lot of misconception that you only have to roll over your gain or you only have to roll over the cash that's left over at the sale. And that's wrong. So the goal is to buy equal or greater value and to roll all the sale proceeds after the closing through the exchange account and into the new property. And so people really need to call ahead to kind of walk through their specific numbers and their plans.
Now, if someone is interested, how would they get a hold of you, Patty?
Yeah. So I'm right in downtown Boston. So my number is 617-423-1031. It's IPX 1031 Exchange. And Deborah certainly has all my contact information. We've worked together before. So I think Deborah's is the first line of defense.
How would they get a hold of you?
Just call me on my cellular phone at 617-201-4730, and I'm happy to help.
And I'm Rick Kaplan from the New England Real Estate Journal, and thank you for watching Let's Talk Somerville Real Estate.